Welcome to this BPT class. My name's Kieran Doe. I'm a senior tutor at ACA Masters and multiple ICAEW prize winner. During this class, I'll be working through an exam question on corporation tax losses and groups. This class is taken from our BPT video course. The course greatly simplifies the BPT technical content and works through lots of questions so you can see the exam technique you should be using in your BPT exam. The course covers all of the key technical areas and question types, and each class simplifies the technical content before I work through some exam questions to demonstrate the exam technique to use. This exam technique has resulted in several students scoring close to 100% in the BPT exam, despite having previously failed. We've even had some students on their fourth attempt getting well into the 80s. So therefore you can see how much value these BPT classes will add and how this exam technique will enable you to also score a high mark in your BPT exam. So full details about the video course can be found on the BPT page of the ACA Masters website, and you'll also find some other free sample classes here as well. There's one on family investment companies and trusts, and also one from an earlier year on starting a business. And this, of course, is the losses and groups question, which you are about to see me work through in full. So full details for the rest of the course on the BPT page of the ACA Masters website. Now, as I work through this question, you'll also see me refer to our BPT open book notes. So these summarize the key technical content ready for you to use in your exam. So they're a time efficient resource for you to use when answering exam questions. So obviously in this class, we'll be looking at corporation tax. So you'll see me referring a lot to the corporation tax sections in terms of corporation tax liability, and also primarily when we're thinking about the best way to use a loss and how a loss can be used and the things to consider. But once again, full details for our BPT materials can be found on the BPT page of the ACA Masters website. So in this question, we take a look at the requirements. We can see that we needed to explain the options for using the losses in the group and identify the most efficient use of each loss. So we need to explain the options for using the loss and identify the most efficient use of each loss. Then we need to calculate the tax liability for each company in the group for the year ended 31st of March. So calculate the tax liability, so more of a computational requirement there. You should incorporate your recommended use of the losses from part 1. So explain the options for the losses, identify the most efficient use of the loss, and then calculate the tax liability for each company in the group after making any claims for use of the losses. And we can see here we had to draft a response to the FD explaining the differing corporation tax consequence of the alternative structures. So that sounds like possibly a separate requirement there and kind of unrelated to this first part. And then we can see here we've got ethics. So if you have a kind of a quick high level look through, we've got, you can see Exhibit 1, Exhibit 2, and Exhibit 3 here. That seems to be for ethics, as we can see there. This is the email from the finance director. So therefore, setting up an overseas business, that's presumably relates to this part. And then we've got Exhibit 1, the profits and losses of the group company, which is obviously for the first part. And you can kind of see these first two parts relate to one another. So we can see here that we had Exhibit 1, which gives us the results of the group companies. We can see the different types of income, the types of income you'd expect to see in a corporation tax computation. If you think about what the corporation tax computation looks like, obviously these different types of income, trading, property, NTLR gains to get us to the total profits. And then, of course, we know that we need to come through and calculate the CT liability once we've used the losses. So we can see how that's going to be useful. And then we've got some narrative to go with it to tell us about the trading results, capital transactions, and we can already see where some of the losses are already. So that's obviously useful for these first two parts of the question. And then we've got exhibit 2, and we know the email from the finance director about setting up like an overseas business. That, of course, is relevant for that part of the question. And then we've got a final exhibit for ethics. So in terms of mark allocation, I'd suggest giving 8 marks to ethics. So therefore, it's always quite nice when ethics comes up in a question. It's really helpful there with the mark allocation. So therefore, we'd have 32 to split between these two parts. Now, if you're going through the options of setting up a permanent establishment or setting up an incorporated company, there'll be quite a few points to make there. And we'll see this in more detail when we look at the international class. But if it isn't overly detailed and there's not a huge amount of numbers here to work with, we're told some profits and we're told a little bit about tax rates, but there aren't lots of numbers to work with. There's not lots of information to work with here as well. Now, I'd probably suggest maybe going for about 12 there. If we've got 32, we could give 12 to this part and then 20 here, or maybe give 10 to this part and 22 here. It wouldn't make too much of a difference. It's just a way that we can estimate how much time we should spend on each part of the question. So we can go 8, 12, and then I do these two together because this part kind of feeds into this part. There'll certainly be more to do here because we're going to need to go through, explain how each of the losses can be used, identify the best way to use them as well, and then recalculate or calculate the tax liabilities for each company. So definitely more to do there. So hopefully you can kind of see how I've allocated the marks there. Yeah, ethics always go for 8 marks. And then the other parts, I've done it based on what we need to do. So there's obviously 2 parts of the question here related to exhibit 1. There's 2 requirements for exhibit 1. There's a lot of numbers to work with. There's probably a bit more information overall. We know with like losses, there's a lot of rules, there's different options as to how we can use the loss as well. So there'll be a lot to work through there. And then we need to calculate the tax liabilities for each company in the group. So certainly more to do there than this part of the question. Then we can see the amount of time we'll have to spend for each part of the question. We'll have our 20 marks for the first 2 parts, 1.5 minutes per mark, so 30 minutes there, 18 for the overseas business part, and then 12 marks there for the ethics. And this will enable us to attempt every part of the question and therefore pick up the easy and the medium marks on each part of the question. Every part will have some easy bits, some medium bits, and some really hard marks. So what you want to do is make sure you get through all of the requirements so you can get the easy and the medium marks. And with the headroom marks available, that should enable you to get close to full marks on the question overall. There's no point spending an excessive amount of time trying to chase the really hard marks here and here, run out of time, and then not have time to get the easy marks here. Be better off moving on within time, abandoning the really hard bits here, and then making sure that you get the easy marks there. A mark is worth a mark at the end of the day, and therefore you want to grab that low hanging fruit. Now, I'm not suggesting that you leave out lots of the question, but if there's really difficult technical computational bits that aren't going to have a big significant impact on the answer, then you could possibly think, well, I'm running out of time, better to move on, make sure I've got enough time for ethics because there should be a nice few easy marks there, or even make sure I move on with enough time to get onto the overseas business bit because I know there's some quite basic, easy points you can mention about P's versus overseas incorporated subsidiaries. So it's all about your overall exam strategy, and that really helps here. Doing this estimation of the marks and therefore allocating your time will really help with that. It will help you attempt every requirement that has been set. And I do suggest doing them in order because it can be quite often that the ethics part relates to some of the earlier bits in the scenario. So it makes sense to kind of do it in order so that if there is anything that feeds through from an earlier part into a later part, then you'll be able to incorporate that into your answer. So once we've looked at the requirements, got a high level feel for the question, what we need to do, the order we're going to approach things, Then we can start reading through the intro bit at the start. So we're an ICAEW accountant working in practice as a tax advisor. So we don't work in this company itself. We're an external tax advisor. So the ESR retail group, so they're retailers. So that sounds like it's a trading business. So it's a client of your firm. ESR is a holding company. So ESR is like a parent company of the group, the holding company, and owns 100% in all four trading companies. So there's four trading companies: All Sport, JJD, Direct Soccer, and Intersport. So all companies have a 31st of March year end, so we're not going to have any issues here with corresponding periods in terms of claiming and surrendering losses. So we've got the holding company and then four trading companies. So quite a straightforward group, really. And we can kind of see this here. This is the holding company and then the four trading companies. It's quite straightforward in terms of the group structure, because we'll be able to see, of course, that these are all part of the group relief group and all part of the chargeable gains group. Now, it's not as though we've got subsidiaries, and therefore we're thinking about effective interest to see if they're part of the group relief and the gains groups. We haven't got like consortium companies. It's very straightforward here in terms of this group. And of course, they've all got the same year end. And as far as we know, they've all been owned for the whole period, unless we're told otherwise, we'd assume that. Therefore, we're not going to have any issues when they're only part of the group for part of the period, and therefore only part of the loss can be claimed. So this is fairly or very straightforward, really, in terms of the group structure. So there are several tax losses in the group, and the client has asked your firm to identify the most efficient use of the losses, as we've already seen in the requirement. Exhibit 1 summarises the profits and losses of the group companies, as we've seen. And then it comes on to explain a little bit about the second requirement, which we're going to come back to, and the ethics part, which we will come back to. So here we can see the results of the group for the year ended 31st of March. So we've got these here, as we've said, the types of income you'd expect to see for companies: trading, property, non-trading interest, and chargeable gains. And some losses here as well. So we've got quite a few losses to deal with. So the holding company has got a chargeable loss. So tax profile of the holding company: no trading income, which is what you'd expect. What's going on here? It just holds the shareholding in these other companies. They do the trading. The retail stores, they'll make the profits. They probably pay it up to the parent company, who then pays it out to the shareholders. We don't know who owns the group, who those shareholders are. That's not a matter of concern for this question. So you can see that the tax profile of the holding company, it has some small amount of property income. So maybe it's just renting out an investment property or something like that, possibly renting out to one of the subsidiaries. We'll have to see. It's got a chargeable loss as well. So we're thinking, how can we use that? But of course, we know they're part of the chargeable gains group, so you could reallocate a gain from another company or reallocate the loss to another company. So then we've got the trading companies. So trading profits here, this has got the highest trading profits. It's got some NTLR income as well, so maybe some interest receivable. We'll have to find out what that is, or we might find out what it is. It doesn't really matter too much. We know it's taxable. Nothing else in that company. JJD, so this is the one with a loss. So it's got a trading loss. And then we've got an NTLR loss as well in that company. But it does have a chargeable gain. So we'll be thinking about, we know this can be offset against gains. We'll be looking to use that loss against this gain. And then we've got Direct Soccer. So again, a profitable trading income and NTLR income. And then IS, it's got trading profit and NTLR income as well. So most of the trading businesses are profitable. They've got trading income and NTLR. We've just got this JJD, which has got losses, and then the holding company's got a chargeable loss as well. So we need to think about how we'll use those losses. So we're told JJD has performed poorly in recent years and has unused trading losses brought forward of 36k. So it's got brought forward trading losses as well. So we'll be thinking about how we're going to, use these losses. We've got trading losses and an NTLR loss in the current year. Also got a brought forward trading loss as well. So, that could also, be used by the same company or the group. Now, there is, of course, more of a restriction on using brought forward losses. So we'll have to come back and think about that, whether that would apply. But particularly the deductions allowance, which of course is 5 million, profits in these group companies is obviously below that. Also has an NTLR brought forward loss, 18,000 from costs of raising finance in 2022. So it's got a brought forward NTLR deficit, so non-trade loan relationship deficit. So it has some costs of raising finance, which of course we know is included as part of NTLR. So yeah, that makes sense as to why it's got an NTLR deficit brought forward. The group has surplus cash, which has generated interest on bank deposits in trading companies. So it sounds like the group's got plenty of cash and therefore it's generating interest income on the bank deposits. So this could be a factor when we're thinking about which loss relief to claim. Sometimes, as we discussed in the earlier class, we said that it might be the case that using a loss like in the future perhaps might save tax at a higher rate, whereas carrying it back or using it in the current year might be obtaining tax relief at a lower rate. However, there could be a cash flow benefit, or there would be a cash flow benefit of using that loss earlier. So therefore, there could be almost like a conflict between the two, and therefore the client would probably need to specify what is the priority. It sounds as though the cash flow timing isn't the priority here because they're obviously generating plenty of cash. So we talked about capital transactions. So the holding company disposed of an investment property during the year, realizing a chargeable loss of 22k. So that was an investment property. So, might be thinking, and as we discussed in the relief class, both for CGT, IHT, and also corporation tax, the reliefs are mainly available for trading companies on trading assets. An investment property, of course, isn't a trading asset. So if it had a gain, wouldn't it be able to roll it over, for example? Thinking about land and buildings here, and as I said previously, with disposals of land and buildings, you're always looking to kind of roll over that gain where you can. Always look to see if you can claim rollover relief, but of course we know that's only for trading assets. In addition, a loss was made as well, so it isn't a gain that can be rolled over. It's a chargeable loss that can still be used. It also has a chargeable loss brought forward of 16,000. So it's got a chargeable loss in a year, but it's also got a chargeable loss brought forward as well. So we'll need to be thinking about how that can be used as well. Of course, it can only be offset against chargeable gains, just like any chargeable loss, with very few exceptions to that. And of course, the same applies for individuals as well, can generally only be used against chargeable gains. More restrictive capital losses, i.e. chargeable losses, are more restrictive than like trading, property and NTLR losses. So JJD disposed of an unperforming retail store, which gave rise to a chargeable gain of 33k. So we've seen that there. So that is a retail store. So we could possibly look to claim rollover relief if they bought other trading assets, either in the year before or 3 years after. But we are told below, no purchases of retail stores have been made in recent years, as the group's strategy is to focus on expanding its online presence rather than purchasing more retail stores. So that's a bit of a hint there that they won't be able to claim rollover relief because they're not purchasing more tangible assets. Plus also, we don't really need to roll this gain over because we can cover it with the chargeable loss. There's a chargeable loss in the current year, but there's also the chargeable loss brought forward. So the way to do that, remember, when you're in a chargeable gains group, it's not only the loss that can move. So of course, just like with a group relief group, in a group relief group, it's the loss that moves. So JJD can surrender this loss to any of these companies, within the group that've got profits to take it. It's a loss that moves with a group relief group. When you're in a chargeable gains group, yes, the loss can move. Current year loss can be reallocated to other companies, so ESR could reallocate the loss here. But remember, you can also move the gain, and that's something you can't do, at least directly, with your trading property and NTLR. And when you're part of a chargeable gains group, you can also reallocate the gain. So this is quite useful when you've got a brought forward loss, because we know that ESR, yes, it's got this current year loss of 22, but it's got this brought forward loss of 16. Now that brought forward loss can't be like surrendered for group relief, you can see here, unlike with the other types. So the way to be able to use that when the gain's in the other company is we move this gain from JJD into ESR. So ESR would have the gain of 33, but it would have the 22 loss in the current year to offset it and the brought forward loss. So that would be the best way to use that. Therefore, we don't even really need to consider rollover relief because they may as well just use the losses up now. That would be better rather than keeping the losses available, unless there was another reason for that, but that would be quite unlikely. So therefore, we can already see really how we're going to use the chargeable loss, and then we can think about how we would use the trading loss in JJD. So, if we kind of copy this over, we can then see how we would use a loss. Remember, we need to do a revised calculation of the taxable profit. So therefore, we need all this information. So you can copy this over into the spreadsheet area so that you can do the calculations. But you can see that the current position of the companies here. And we know the types of losses we've got to deal with. We've got this chargeable loss in the current year that can go against gains, and we've got like a brought forward loss as well, which can be offset against the gains. We've already thought about that. Then we've got current year trading losses, which can be used by JJD itself, or it can group relieve it to another company. It's also got brought forward losses as well, and the same applies. It can use it itself or group relieve it to another company. A few more restrictions here in that the company has to use it before it surrenders, and if the surrendering company's got brought forward losses, which none of them do, so that point's not relevant. And also there's a 5 million deductions allowance, so you can only cover 5 million of the current year profits with brought forward losses. But that's not going to be an issue here. We can see a company's got just under 2.5 million of profits. So therefore, that's all going to fall well within the deductions allowance. So therefore, we haven't really got this issue that we saw in previous questions, like when we work through MB from the past exam. That focused heavily on the deductions allowance because of the size of the numbers in the group. They were big, multi-million pound profits and losses, and therefore the deductions allowance was an issue there. We're looking at brought forward losses, how they could be offset, but to think about the deductions allowance, where best to offset it, either against the gains or against trading income, nearly always best to offset that there against the gains, as we saw. But that isn't an issue here, so these points aren't going to be as relevant here in this question. So we're going to need to think about where to offset those brought forward and those current year losses in the group. Now, of course, we covered this in detail in the earlier class, but as I said, it's best to use more restrictive capital losses first, because you can see that actually JJD could cover this chargeable gain with its trading loss. It's got a trading loss in the year and an NTLR loss and brought forward losses. It could use either of those to cover the gain. They're carried forward against total profits and using the current year against total profits. So it could use this loss and also the brought forward loss, either or, against the gain. But if they did that, then you're using up a trading loss against the gain, but we've got this chargeable loss over here that can't be used against anything else. If you cover the gain with the trading loss, what are you going to use this for? Nothing. It's going to not be used, and it's going to be carried forward. And then there's a real risk that effectively kind of gets trapped because it's so restrictive. It can only be used against gains. If they don't make any more gains in the future, then that loss won't get used. Whereas a trading loss is so flexible that it can be used against trading, property, NTLR. Like in a trading group where there's lots of trading profits, this loss is going to be used pretty easily and pretty quickly. Whereas this one, perhaps not so much. So therefore, we're going to try to use that more restrictive capital loss first. And we've already said how we're going to use it. We're going to put this gain into here, and there's a brought forward capital loss, brought forward chargeable loss as well in this company, in the parent holding company of the 16K. So therefore, those losses would be able to 38K of losses would be able to cover this gain. So that would be the obvious place there. So that's what we would do there. Would be the first thing that we would do. And then we would need to think about how we would use the trading loss. And there's different things we could think about here, but a very important consideration is the tax rates that the companies are paying at. So we're also going to need to think quite carefully about that. And we'll also think about cash flow as well, because some of the companies may be paying by installments and others not. And we can also think as well, like a current year or carry back claim is better than a carry forward claim if we were to suggest that. I don't think we're going to have to think about DTR and QCD. None of them have made qualifying charitable donations. None of them have got overseas income that's also being taxed overseas. So we're not having to be careful about preserving DTR, just as we saw in that earlier question of MB and wrapper. And of course, in other questions as well, we've seen the importance of the impact on cash flow in terms of installments. So we'll be thinking about that as well. So we've got quite a bit that we're going to have to consider here in our answer. It's definitely worth thinking about the tax rates that the companies pay at. So if we just have a brief reminder of how companies pay corporation tax, so we've got the different types of income, get to the total profits, then those profits are taxed depending on the level of the profits. So we use a concept called augmented profits, which is the total taxable profits plus the dividends received from non-51% group companies. So remember, dividends received by a company are exempt in almost all cases. So dividends themselves are exempt, but they are taken into account if they're from non-51% group companies when determining the rate of tax that the company pays at. So if profits are below 50K, company pays tax at 19%. If profits are above 50K, company pays tax at 25%. So obviously that's a huge jump. Remember, these aren't tax bands. It's not the first 50Ks at 19% and then over 50Ks at 25%. It's if you're over 50K, all the profits are taxed at 25%. And therefore that would cause a lot of disincentives of earning profits above 50K unless there was some sort of relief available to kind of smooth that transition up. And that's why we have the marginal relief available, and that'll bring the effective tax rate down on those profits and smooth the transition from 19% to 25%. So that would apply on profits between these two limits here. So these limits are apportioned or reduced if there's 51% associates or if it's kind of a short accounting period. So of course, if we look here at the companies within the group, now when we're looking at associates, it's 51% associates. So whenever I've kind of got a group scenario, I always kind of think, how many associates are there? Are they part of the group relief group and are they part of the chargeable gains group? Now, I'm not going to write about all of these, in my answer, but just when I see the group structure, that's kind of the first thing, I think about, because that could be relevant, in part of my answer. But, I'm only going to bring this into my answer if it's relevant to the scenario. The examiners say that too many students, whenever they just see a group, they just start going through, is it part of a group relief group? Is it part of a gains group? But that's only relevant if they've got losses. Group relief group is for surrendering losses. If there aren't any losses, it's irrelevant whether they're part of a group relief group. It's irrelevant to the scenario. Just like if, being part of a chargeable gains group, yes, it can mean you can do group-wide rollover relief claims. It does mean you can aggregate SSE holdings for SSE. It does mean you can transfer assets at no gain, no loss. But that's only relevant if the group are doing these things. So therefore, only bring this into your answer if it's specifically relevant. But clearly it is going to be here, the number of associates, because that's going to impact, the rate of tax, the payment dates, etc. Group belief group is definitely going to be relevant, as is a chargeable gains group. So we will bring this into our answer here. VAT grouping isn't going to be relevant. It's just a pure corporation tax question. And neither will stamp duty. They are part of a stamp duty group. I'm not going to mention this in my answer. It's questions about corporation tax losses. I'm not going to mention they're part of a stamp duty group. Also, it's irrelevant because they haven't transferred any assets between them. So there's no relevance of that. There's no significance of that. But certainly the fact that they are all associates is definitely relevant, because that is going to mean that when we're looking at the rate of tax, when deciding the best use for the loss, that's going to be affected by this, because we know the limits. Profits below 50k taxed at 19%. Well, for these group companies, it isn't going to be 50k because there's 5 associated companies. Therefore, it's going to be 10k. For a company in this group to pay at 19%, they're going to need profits less than 10k. So we can see that ESR is there, so they're paying tax at 19%. Now, anyone with profits above 250k, again, a portion for the 5 companies within the group. So anyone with profits above 50k is going to pay at the main rate. So of course we can see here who's got profits above 50k. They haven't, but All Sport do. So they're paying at the main rate. JD, we'll have to come back, decide how that loss is used first. But if we're moving that gain out of there, they're not going to have anything. So it if they've got anything left, it's going to be at 19%. So they're paying at the main rate. Now companies fall in between the two. So if you've got profits of more than 10k, then they'll be paying at the main rate. However, they'll be getting marginal relief. So a company that's falling between these two amounts, so between the 10k and the 50k, will be paying at the marginal rate. And I'll just demonstrate briefly how this works, because if you've got a company falling between these two amounts, then they'll be claiming marginal relief. There's a shortcut calculation we can do to calculate that. So for example, we said below 10k, 50k a portion, paying at 19%. So we know that the holding company is paying at 19%. Calculating its tax liability is easy, 19%. All Sport, way above the limit, therefore going to be paying at 25%. So of course, anyone with profits over 10k is paying at 25%, but they will be getting marginal relief. And that means that the effective rate they're paying at on those profits between the two is 26.5%. And I'll demonstrate how that works. So they're not between the two, and neither is direct soccer. So we'll have direct soccer will be paying at the main rate. And then we've got Intersport, because they are paying at the main rate. So, when you fall between the two, yes, profits are taxed at 25%, like we said. Now, I said here, as soon as profits are above 50k, obviously for this group it's 10k because we've apportioned it down, profits above 10k are taxed at the main rate. They are taxed at 25%. But because they're just over the limit, or they're not right up into above that upper limit, then they will get marginal relief. Now you can actually see they are very close to the 50k, so we wouldn't expect them to get much in the way of marginal relief. But if we were to do the calculation in full, and you do have all the thresholds in Hardman's, then you would need to take, the upper limit, which is the point at which marginal relief stops, and therefore it would just paying it purely at 25%. Take the upper limit, take the augmented profit, so it doesn't have any dividends from any other companies. It's a difference between the two, and then you multiply it by the marginal relief fraction, which is in your open book. But I'm going to show you a shortcut method, which is going to be easier to use in a BPT exam. So then they'll get marginal relief, and therefore actually the tax liability will be this. And if you look at this on an effective basis, tax of this on profits of this means they're effectively paying tax at 24.5%. 26.8%, overall. So you can see what marginal relief is doing. It's basically smoothing the transition from 19% up to 25%. And I covered this in detail in the earlier class. But just to demonstrate with another, kind of really brief example, if they were, closer to the 10,000, maybe like 11,000, if they were closer to the limit of 10,000 and they only had profits of say like 11,000, then you'd expect the tax rate to be much closer to 19%. So obviously calculating a tax liability for marginal relief companies is very computational to calculate the marginal relief. Now, in most cases, what you'll be able to do is do a shortcut method, because the way this effectively works is that a company paying at the marginal rate is effectively that the first 10,000 are at the 19%, and then the next tranche is at the 26.5%. So if we've got total profits here of this, then the way this is effectively working to calculate this tax liability is that the first 10,000 are effectively at 19%, and the amounts that's falling into that marginal amount between the 10 and the 50k is effectively at 26.5%. And therefore you can see how I got to that same tax liability, but without doing the full marginal relief calculation. So this works when there aren't any dividends from non-50% associates, non-51% group companies. So when the total taxable profits are the same as the augmented profits. And I think in the BPT exam, they'll give it to you like this, so you can quickly calculate what the tax liability is. So therefore you can see I didn't need all of these calculations, but you can see by using this method, you can see what I mean when I say that the effective tax on some of those profits is 26.5%, because if the company only had 10k of profits, we know it'd only be at 19%. But because it's gone above that, it's paying tax at 25%, but we're getting a deduction for the marginal relief, and therefore that brings that liability down to this. So the overall tax on those profits is less than 25%, because of course they are getting some relief there. So it's 25%, and then they're getting a deduction. So it must be below 25%, their effective tax rate. But the way that works is that those profits in between are effectively being taxed at a higher rate. So therefore, when we're looking to use losses within the group, this is the effective, or the highest effective tax rate that there would, those profits falling between the small profits rate and the upper limit where it's purely taxed at 25, and a small profit rate where it's purely taxed at 19. When you've got marginal relief companies, then the profits which are falling into that marginal amount, so between the 10k and the 50k, i.e. in this case, the 33.8k, those profits are effectively being taxed at 26.5%. And therefore we want to target those profits with losses, because that will save tax at the highest rate. So that is quite complicated in terms of how the marginal relief works and how it gets to that effective tax rate. But I think if you understand it, then it will really help you appreciate why it's best to target losses against marginal rate profits. And therefore that's going to be our strategy here. We're going to want to target it at profit, the losses at profits at the marginal rate, and then obviously after that, the main rate, because that's higher than the small profits rate. So group scenario, target the profits at the marginal rate, but because group relief isn't an all or nothing claim, therefore what we can do is we can just surrender an amount of profits to IS to bring the profits down to the 10k and just leave them 10k of profit paying at 19%, because there will be enough profits there to do that, because we only need to cover 33.8k of profits. So therefore we'd want to be making a group relief claim here against that. And then we'd have the remaining, so there'll still be a loss remaining because there's a brought forward loss and there's the current year losses, as the brought forward and the current year losses, we would then want to be surrendering those to companies paying at the main rate. And therefore we can think about, would it go to direct soccer because they could take the rest of it, or should it go to all sport? And then maybe we'll be thinking as well about who's paying tax earlier between the two. And that was also affected by the associates as well. So we'll come back to think about that. But, if you just recap from earlier studies, companies with augmented profits more than 1.5 million, less than 1.5 million, pay their tax 9 months and a day after the end of the accounting period. Whereas large companies pay in installments, and the first installment is during the accounting period. This is all after the accounting period. Company paying by installments will pay all of their tax before this small companies have paid it. So therefore, better to relieve it to large companies, or if there are very large companies, and they won't be in this group because the profit levels are much smaller, but very large companies pay them even earlier. So therefore, that's a cash flow consideration when determining how to use a loss. But you might be looking at this again and thinking, well, only all sport would be paying by installments, but just because they've got profits of more than the 1.5 million. But just remember, once again, that 1.5 million is affected by the associated companies in the group. So therefore, the profit levels are going to be lower. It's 300k, but we can see actually direct soccer still won't be paying by installments. So only all sport is paying by the quarterly installment. So therefore, once a loss has been used saving tax at this rate, we would then allocate it to all sport before direct soccer. So there is kind of quite a lot going on there with the group, and you can really see here the importance of these considerations, which losses to use first, capital losses more restrictive, then thinking about the impact of tax rates. You want to save tax at the highest rate, and the marginal relief aspects are quite complicated here. And then we've also got cash flow consideration as well. If you're carrying losses forward, are there definitely sufficient profits? What rate of tax will those profits be at? We're not told anything about that in the question about what next year's profits would be. We're not told about previous years as well, so we can't really think about a carry back claim. We haven't got QCDs and DTR, as we've said, thankfully, because I think there's probably enough going on in this question. So we've kind of got a good idea now of how we are going to use these losses. Now, you may have gone that far and looked at those technical parts first of all, or you may have just decided that you'd start first of all by thinking and explaining how each of the losses can be used, because that is the easier part of the question. And I'd always suggest doing that in the exam. You should always start with the relevant parts of the relevant tax rules and apply it to the scenario. Definitely don't jump in doing the hard bit saying, this amount of loss should be surrendered to Intersport to save tax at the marginal rate. Yes, well, that's definitely correct, and that is the right approach to take. There's a lot more easier points you could have made to get there. And I've explained these points kind of as I've gone through. So I always suggest briefly mentioning the relevant parts of the relevant tax rules. So in this scenario, it is relevant to explain who is part of the group relief group, who is part of the chargeable gains group, because there are losses which can be surrendered via group relief, and we're going to be surrendering losses via group relief. So therefore, it is relevant to explain who is part of the group relief group. But like I've said, whenever you've got like a corporation tax question and there's several companies in the group, don't always just start writing about group relief groups and chargeable gains groups. If they're not relevant, if there aren't losses in a group, don't write about a group relief group. With a chargeable gains group, if there aren't chargeable losses, or there's not transfers at no gain, no loss, or like degrouping charges or anything like that, then it wouldn't be relevant. So only to bring the relevant tax rules in. So you could say that all companies are part of group relief group because ESR owns 100% direct in all subsidiaries, i.e. more than 75%. That's the key point there. Or you could put, owns, more than 75% direct in all subsidiaries. And you could just put in brackets there, because they're wholly owned, it owns 100%. So that's the relevant amount. Make sure you get like the technical, the part in, the bit which deems them to be relevant part of the group relief group, and that is of course the 75%, direct and indirect. We don't need to worry about indirect here because it owns them all directly. And you could say, all part of a group relief group and chargeable gains group, because ESR owns more than 75% in all subs. So you could say, group relief group enables trading and NTLR losses. So I'm not going to write about property losses. Yes, it does mean they can surrender property losses as well. I'm not writing about property losses because there aren't property losses. So group relief enables trading and NTLR losses to be surrendered to other group relief companies. And it would be relevant here to talk about brought forward and carried forward losses. So you could say this applies to brought forward and current year losses, because there are brought forward and current year losses. I'm not even going to talk about carryback. You can't do a group relief claim for carryback anyway, but I'm not even going to mention that because we're not considering that in the question. So trading and NTLR losses to be surrendered against other group companies applies to brought forward and carried forward losses. Losses offset against total taxable profits. So that's why those losses are, more flexible than a chargeable loss. So like chargeable gains group, so group relief group enables chargeable gains group, enables reallocation of gains and losses in current year. And then we could put, so that doesn't apply to brought forward losses where you reallocate the gains and the losses in the current year. And then we could say, losses offset against chargeable gains only. And this is why they're more restrictive. Trading losses go against total profits. Chargeable gains only go against chargeable gains. So, losses on trading property and NTLR much more flexible than gains. And that's why we're going to focus on using that chargeable loss first of all. So yeah, we've mentioned the relevant rules, and that's useful because it should pick us up a couple of marks, but also it sets us up nicely for the answer. We know which way we're going to be going with this question because we know what we can now do with the losses. So you could have also mentioned the payment dates. We could just mention this when we come on to the next part, but we know that is going to be relevant because we have looked at the thresholds, and we can see that is going to be a determining factor. So you could mention that as well. So there are 5 associates in the group, because more than 51%. Remember, it's 51% for associates, so 75% direct for gains group and group relief group, but only 51% indirect, remember, for chargeable gains group. So lower threshold there, but group relief is 75% effective interest. But that wasn't relevant to this question, so we didn't really need to go into that. But for the associates, it's 51%. So you could put here, this will reduce, or this reduces limits for paying by installments and also tax rates as well. So that's obviously going to be a consideration when we get on to considering how to use the loss. So we could put those on now. We could come on to them after. We've already worked them out. So you could put that here. It clearly shows the examiner we know what we're doing here. And then, of course, profits fall in between those two, 25%, plus the marginal relief. We're going to show that quite clearly when we get on to the next part of the question. So therefore, we brought in the relevant parts of the relevant standards, the relevant parts of the relevant tax rules, and now we can start really applying this to the scenario. We've already kind of thought out the route that we're going to take here. But when you've got these losses, like we said, think about how to use the capital losses first, because they are the most restrictive, as we've just explained there. So we could say, as capital loss or chargeable loss, you can really use those terms interchangeably. Less flexible, should try to use up that loss first. Otherwise, it could effectively get trapped in the company, because if it just ends up getting carried forward, they'd have to realize a gain in the future to be able to use it. And really, we want to, when we've got a gain, you could kind of think of it like the rare opportunity to use a capital loss. You want to make sure you use it. You don't want to use a trading loss first and cover the gain and then end up with having a chargeable loss surplus. So you could say, as ESR has current year and brought forward capital loss, can reallocate gain from JJD to ESR to use the losses. So in the current year, they could move the ESR loss to JJD. Like the loss can move in the current year, or the gain can move. But it's a brought forward loss that's the kind of issue here, because we've got the brought forward loss can only be offset against chargeable gains, but it can't be group relieved. So you couldn't reallocate it in the year. You can only reallocate it in that current year. So therefore, the best thing to do would be to move the gain from JJD into ESR. And of course, we can see how that works. So what we would effectively be doing is you will just move this gain into here. So therefore, that ESR would have a gain, but they've got this capital loss brought forward of the 16k, and in fact they won't even be able to use it all, because that's only 11 of a gain left. So it will leave some capital loss brought forward. So this is like a brought forward loss, brought forward loss, but then there would still be like a carried forward loss here, because they've only used 11k of it, and therefore that would just leave these taxable profits here, subject to tax, because there'd be no chargeable gain. So therefore that would leave a carried forward loss here. Sometimes the questions state you have to show the carried forward loss. Always good practice to do so. So we could say there would be a carried forward capital loss, chargeable loss in ESG of 5k carried forward to offset against future gains. And again, they could do the same thing. If any other group company gets a gain, reallocate it here, and therefore they'd be able to use that brought forward loss, just as we have done here. So therefore, we've explained how we're going to use the capital loss. If you want to be really, really friendly to the examiner, you could even just have a little subheading here, capital loss, less flexible. Let's use that up first. Reallocate it into the company, reallocate the gain into the company with the brought forward loss, and therefore use that up in full. So then we've got JD's losses. So we've got the loss, we've got the loss brought forward, and then we've got the loss in the current year as well. So they've got a trading loss of the 92k, NTLR loss of the 1200. So they've got the brought forward and the current year losses as well. So yeah, there is a restriction. There are some restrictions on brought forward losses, as we've discussed. So like this surrendering company has to use it first of all. The claimant company has to use any brought forward losses. Well, no other company in the group's got brought forward losses. Surrendering company doesn't have anything left in it now to be able to use the losses against. So therefore it will be able to surrender them for group relief. Can only cover 5 million of profits with brought forward losses. That's not relevant to this group. The profits are too small, as I've said earlier. So therefore that isn't going to be an issue here. So therefore we'll be able to surrender those brought forward losses. As we kind of explained here, part of a group relief group, you can surrender brought forward losses as well. So you could put brought forward losses. You could just put trading and NTLR. So we've got the brought forward losses here for the trade in NTLR. So we could briefly mention the rule that you've considered it. Brought forward losses can only offset. We've already explained that you can group relieve them, so we don't need to explain that again. Can only offset 50% of total taxable profits in current year. But then you could put, however, 5 million deductions allowance available, and group profits below that. So we went through this in detail, and we saw this a lot in the MB question. And that had a much different tax profile, didn't it? Where profits in the millions, and therefore there were restrictions on how they could use those losses. But obviously that isn't an issue here because the profits are way below that. So yes, we'd be looking at the profits and we'd be saying, can only cover 50% of the profits, when it surrenders it to, All Sport or whoever, or Intersport. But there's a 5 million allowance that we've already seen, and that obviously more than covers it. And you could briefly mention, some of the other rules as well, claimant company, but none of these are really that relevant. So you could have briefly mentioned that, the claimant company and the surrendering company need to use any of their own brought forward losses first of all, but that isn't an issue here. Now, what the main issue is, as we've explained, who should it surrender to? Well, as we've said, Intersport paying tax, some of those profits are falling into the marginal rate. So therefore it'd be best to surrender there. First of all, as we've already explained here with the tax rates and how they work, because Intersport is, it's above the 10K, so it's paying at the main rate, but it's getting marginal relief because it's less than 50K. And the way that effectively works is profits are effectively first 10K tax at 19%, and then those marginal profits 26.5%. So those marginal profits are at a higher rate than the other companies, even those paying at the main rate. So that's going to be a main consideration here. So JJD should surrender to Intersport because Intersport a marginal relief company, so profits above 10K or profits between 10K and 50K being taxed at 26.5%. Therefore, group relief to Intersport to bring Intersport total taxable profits down to 10K. And this is a great thing about group relief. When you're doing a current year group relief claim, it's not like an all or nothing claim. You can use a certain amount of the loss. So you've kind of explained there, the profits there. How that work and those limits, so we've already made that clear to the examiner. We've divided by the right number of associated companies, and even if you hadn't, you'd still get follow-through marks, but it wasn't too difficult here in this scenario. So therefore, that would be the right amount of the loss to use here, the 33.8K. So bring profits down. So group relief claim of 33,800. And you can show the amount of tax that this would save, because obviously that's saving tax there at the 26.5%. So you can see that Intersport's liability is going to change because we're going to do a group relief claim here, and we've got JJD's loss here. So it's got a group relief claim here of 33,800, and therefore that would mean that all of those profits would now be at 19%, so at 1,900, and therefore it's just saving that tax at that marginal rate. This is their tax liability now. This is their tax liability before. So therefore we can see how much tax is being saved as a result, and we've already explained that there. So put the group relief in, and then of course everything being taxed at 19%, and therefore there is no marginal relief there to claim. So obviously you didn't need to go through all those calculations I did. I was just demonstrating to you technically how the marginal rate works. It's a really nice shortcut in the exam to calculate the liability like this or do the tax saving like this. Once you've calculated that, the limit would be the 10,000 and 50,000, the companies fall in between this at the marginal rate, then you want to get them back down to the 10,000. So you can work out how much group relief you need to give them, and that's going to be at the 26.5%. I mean, if they're above the 50k and you've got a lot of the loss, you could bring them all the way from the 25%, back through the marginal rate as well. It could be another option there in another scenario. But of course, you'd be saving tax there at the 25%. So we can see that there we've targeted the marginal relief company, and that's the best thing to do because it saves tax at the highest rate. So you just put here, this will save tax at 26.5% as follows. And that's the amount that's been saved as a result of that claim. So we've got that there. So then we've still got more of this loss, remember. That was a capital loss that's been used. So yes, we've got the brought forward loss. So you could show what was used in the year, obviously the 11k, and that will get us to the carried forward amount. So that was what was used. So then with the trading brought forward loss, we've only used this amount of the loss. So we've still got a lot of losses left to use. So we can think, where would we then surrender the rest to? So this has been now brought down. So this is now being brought down to a 19% company. So we wouldn't want to use it here. We wouldn't want to use it here against this small amount. These small amounts, they're taxed at 19%. It's JD's loss. So therefore it's either All Sport or Direct Soccer. They're both paying at 25%. So from a purely tax saving point of view, it doesn't matter. But when we think about cash flow, like we saw, All Sport is paying its tax earlier. So if you relieve All Sport, then there'll be a cash flow benefit because they're paying their tax earlier. So you'll make that tax saving earlier because they'll have reduced quarterly installment payments. So you could look at it and think, well, we don't want to bring them down too low, so they're we're getting relief at 19%. That's not going to be an issue here. They've got a long way to go before they're going to be paying tax at 19%. So therefore, the rest of the loss can just be used against All Sport. So we can think of how much loss is available here. We've got this amount of the loss that hasn't been used, and it can also use the current year loss as well. So we can kind of see here, how much here is there for All Sport, 113k, 400. So therefore we could put that there. You could split them out between the two just to perhaps be a bit clearer to the examiner. So we put group relief, brought forward, trading loss, and then you could show how the rest of that, so group relief, the brought forward, trading loss, the rest of that to All Sport. So I think I've put, I did that as a current year claim. It doesn't really matter. I'll just put that there. So there wouldn't be as much left of the brought forward loss. So we've got the brought forward loss of the 36,000 that came, and then we've got the 18,000 as well. So we've used up 33.8k of that. So we've got the brought forward trading loss. The rest of that would go to All Sport. Then we've got group relief, the brought forward NTLR loss as well, which works in the same way. You can just group relief that in the same way. So we've got the 18k there. And then we've got the group relief for the current year losses. I mean, you could really just do them together. You could play group relief, current year losses. You could put trading and NTLR, just put them in as a single line there. But we've said, yeah, this and this, and you could just check total about going to all sport, the 113,400 there. So we'll briefly explain why we've offset the losses in that order. So we've already explained it with group relief to Intersport, first of all. So we'd say, remaining brought forward losses and current year losses, group relief to All Sport, because All Sport paying tax by installments and direct soccer paying 9 months and 1 day after accounting period end. So they're paying their tax earlier. So, I mean, you could have several reasons because we're saying that All Sport's paying by installments when direct soccer is paying 9 months and a day after the year end. So we've explained why we're choosing All Sport over direct soccer, but we can make the obvious point as well. ESR, and we could just put other companies, but ESR and Intersport paying corporation tax at 19%, and All Sport paying at 25%. So they're the reasons there. And we've kind of shown that there here in our answer, how we've offset those losses. So then we'd be able to get down to the taxable profits for each group company. And we could just kind of sense check it as we go through. But we know that ESR only started off with property income of this. If we had the chargeable losses, we had the chargeable gain, but the losses got used there against the gain, and the rest get carried forward because they can't be used against anything other than gains. So that makes sense that that's the amount left there. All Sport had trading and NTLR, so that's claimed some of the losses, but actually, JD's losses, which have now, of course, all been used. So obviously, you're going to end up with a small formula issue here, but I'll just put 0 here. So JD's losses have been used in full. Now we used them here, first of all, to Intersports. We started off with JD's brought forward losses. We relieved them to Intersport because Intersport was falling at the marginal rate. So therefore, profits were being taxed at 25, but there was marginal relief, which meant those profits in between were being at 26.5. So we've claimed the 38 here. That's brought them down to the 10K. So that makes sense. That's what our strategy was. So then we've got the remaining JD loss. So the remaining loss from JJD, we had the brought forward, use this for Intersport. Well, I guess that one there was used, uses the capital gain, but we could put use for Intersport, this amount, and therefore that left this amount for All Sport of the brought forward trading loss. They then took the rest of the losses because they were main rate but paying by installments. Definitely wasn't going to bring it down anywhere near the small profits rate, so no additional tax saving there. So it would be the tax liability here. Direct soccer in the end didn't get any of the relief because obviously it was paying 9 months and a day after the year end with profits of that. So we could just mention that there as well. I think we had already mentioned it above here, so probably didn't even need to mention it again there. And therefore we've got our revised profits, our revised total taxable profits, and the tax liability, which is what the question wanted. And we've also shown how the brought forward losses are used as well. So we want to make sure we copy this over for the examiner, so that they can see all of our workings. Don't worry too much about formatting and making it look really neat. I mean, that is sufficient there. They would be able to follow that through. It actually generally copies through better in the exam software rather than Word and Excel. So you can see the exam technique I've used here, same exam technique as always, relevant parts of the tax rules and then go through and apply it to the scenario, calculating the numbers as we can. But when I'm bringing in the relevant parts, I'm only bringing in bits which are directly relevant to the question. Group relief groups and chargeable gain groups were directly relevant to this question because we were surrendering losses and reallocating gains around the group. I've only brought in the bits which are relevant. I've only talked about trading and NTLR losses because they are the type of losses. I've talked about brought forward and current year losses because they are the type of losses we're dealing with. So then thinking about how to use a loss, this is very technical, particularly with some of the tax rates, but you can kind of see, which issues were most relevant here. We had to think about using those capital losses. In a question where there aren't capital losses, don't suggest using the most restrictive capital losses first because there aren't any capital losses. So the examiners, that's the thing they get most frustrated about. People just trying to dump knowledge into the exam when it's not relevant to the scenario, or then even not applying it to the scenario. These are points to kind of help remind you and guide you and think of the types of things to consider when making your decision. Not a list of points to copy out regardless. Whenever the word losses is mentioned, just write all of this down. That's absolutely not what it is. It's kind of to guide you to think about which points are most relevant. But yes, there were capital losses. So use the most restrictive capital losses first. The deductions allowance wasn't relevant. Everything was below 5 million. All of the profits and gains in the current year were below 5 million. That wasn't an issue. The tax rate bit is very technical. It's important that you kind of really appreciate this and understand this. And that's why I went through that full explanation of, marginal relief and how it works, because it helps you kind of understand how this 26.5% tax rate comes about. Because on the face of it, you're probably looking at it, thought rates are 19% and 25%. There is no formal 26.5%, but it's just the way the marginal relief works. Tax at 25, but then they get a bit of a deduction. So the way that effectively works is first 10K at 19%, and then up to the upper limit, at 26.5%. So therefore target those profits first. If you understand how the marginal relief works, then you kind of understand how much to target at the company that's paying at the marginal rate. And that's why we did that there with those losses. And then we had some losses left over, but everybody's paying at 25%. So who do we choose? Well, there's also the cash flow consideration to make as well about with the company paying by installments. And to calculate the tax saved from the loss, the quickest way to do that is just take the loss and multiply it by the tax rate, which is applicable to those profits. So when I wanted to work out the tax saved on that group relief claim to bring Intersport down to this rate, how much tax is being saved on that? Well, that was all profits falling within the marginal rate. So therefore, the tax saved on that loss was the loss, the 33.8K multiplied by the tax rate on those profits, which was effectively being taxed at 26.5%. And therefore, that's how you could work out the tax saved there. So actually, once you've got a good grip on these group loss relief questions, it isn't too difficult. That's probably going to be, one of the main issues. We didn't have to think about consortium relief or changing ownerships or no gain, no loss transfers and degrouping charges. None of that was relevant here, so we didn't need to bring any of that into our answer. But I thought it'd be useful to do this question so you can see, like, in a big corporation tax scenario with losses, how you would work through and think about the best way to use a loss. And there might be in some questions different ways you could go with it, and even if you had decided a different course of action, you still would get credit along the way. Remember, there's lots of headroom marks in BPT. There'll be more marks available than the maximum marks. So even if you made a few mistakes on the way, you would still get plenty of marks. You could even possibly still get full marks. So relevant parts of the scenario, applying it to the scenario is the key, getting the easy marks as we go through, attempting every part of it, including getting those revised liabilities down there. So hopefully that's really helped demonstrate the issues you need to consider when looking at how best to use a loss. So you can, of course, just go and practice some of the other questions around losses and groups. Quite a few have been covered elsewhere in the course. So this one has got some companies paying at the marginal rate. So that's probably the most similar in the current question bank in 2024. That's probably the most similar to the one we've just seen here. This question was more about chargeable gains groups, so that was more relevant here. This was surrendering a loss, but it was a cap, a chargeable loss. So thinking about payment there. This was where there was a lot of brought forward losses. We were thinking about the deductions allowance. That's that MB and wrapper question. So yeah, go away and practice several questions one after the other. These ones are all also covered in the video course, so you can see Haley and myself work through those as well. But very similar exam technique as we've seen throughout the course, as we've seen with CGT, IHT, income tax, and as we'll see in all of the business structuring and restructuring questions, short, concise, range of points, relevant technical parts, and then applying it to the scenario, calculating the numbers where you can. That's the key to getting top marks. That's why so many of our students have scored close to 100% in the BPT exam. Not necessarily technical experts at tax, but really good exam technique, really leveraging off these notes to bring in the relevant parts, the relevant tax rules, but then applying it to the scenario. That is the key bit. That is really the key part, getting a range of points applied to the scenario, covering all the relevant issues and the relevant taxes where there is more than one tax relevant. That's how you get top marks in BPT.